Now Sunday, November 17th, and we have gone one more month and it will be almost a year of a bullish market that I have been very suspect of. So I kind of wanted to go along and show some of the other charts that I think justify my position and try to find where we are in the progression of those charts. And one of those that I like to use is the VIX, otherwise known as the volatility index. The volatility index is calculated based on S&P 500 index options premiums. What that effectively means is what people are paying for option pricing, what kind of protection they're buying. Are they buying calls? Are they buying puts? And some math and derivatives of that. They're able to come up with a index that represents the fear in the marketplace. So the VIX is known as the fear index, supposedly. Now what I do is I turn it upside down. I invert the scale because it's easier for me to see that way. And then I try to correlate that with index pricing. So on this chart I have the VIX in the top pane, and I have the S&P 500 price in the lower pane. And I've overlaid my Elliott wave counts as they relate to price on this pane, and I've overlaid my counts as they relate to the VIX on the top pane, obviously. So one of the things I want to point out is, the market is fractal in nature, meaning the patterns repeat within themselves to a smaller and smaller degree, and we have the same characteristics within the VIX, right? If the VIX is a derivative of price in the market, then the VIX should exhibit similar behavior. And I believe that it does. Similar, not the same. And what we see is a recurring pattern where you have a 1, 2, 3 fills out the top quadrant of my pitchfork, and then we crash, and the fifth wave fills out the top quadrant below the median line of the pitchfork, right? And that is corollary to the first wave, right? We adjust the price here and get it within view. It mimics it, but it's not exact. And let me explain what we tend to see. This is 2009, right? And this period is from 2009 to 2013, 2011 rather, is the first wave that I'm showing you guys here. And what we see is the volatility index actually bottoms before the market bottoms, right? And that's a result of people who are trading put options, selling their put options, taking their profits. People who are short the market saying, okay, I've made enough money, I don't want to risk the market coming back in my face. I want to get out of my put options, and I want to start buying calls to partake in the upside. And that's why we see the volatility index bottom before we see the market bottom, right? The professional investors and the individual traders that have a lot of knowledge are starting to dip their toes back into the market. So volatility recovers before price does, right? And then volatility pretty closely mimics price as we move through the third wave in price, right? And the 3 to 4 correction in volatility very closely mimics the 3 to 4 correction in price. But something interesting happens when we get into the fifth wave. What happens, or at least what I attribute it to, is people don't really know, when we get to the top of the fifth wave, we don't really know exactly where we are, right? We don't know if we should be counting. We don't know if we should be counting this as 1, 2, 3, 4, 5 and being complete, or if it should be counted this way, right? So what we see in fifth waves is volatility diverges from price, right? And because we don't know the exact way we should be counting that, your bigger investors are moving out of the market at what ends up being the peak of the third wave, right? So what you see is in the fifth wave of price, volatility makes its peak at the peak of the third wave, right? And then you have a vol event like we had in February of 2018. You have a vol event, and that is where volatility begins to correct. What actually happens in price is you have a big vol event, then you have the fifth wave in price, and that serves as the A wave of a three-wave correction in volatility, right? A, B, C. What we then have in the markets is the ABC correction, right? The second wave correction. And what corresponds is you have the A wave in price corresponds with this wave in volatility. You have a B wave in price corresponds with this wave in volatility. And the C wave in price becomes another severe vol event, right? Volatility event. So volatility peaks at the third wave of the fifth wave in price, and volatility ebbs at the bottom of the second wave, right? And that's a recurring pattern, right? This was the first wave. If we look at the third wave, the wave that we are just finishing now, right? We can see that that pattern is repeating, right? Let's try to get the zoom correct here. We have the first wave, the second wave, then we have the third wave where volatility and price are very closely matched, right? The third wave moves upward, and then we have the 3-4 correction, which is very closely matched in timing with volatility, right? Then we have, and all this occurs in the top quadrant, right? And then during the 3 to 4 correction, we move into the lower quadrant on volatility and we ride the bottom of the median line until we get to the third wave of the fifth wave, right? If we count that, that is 1, 2, 3, 4, 5, right? And we get to the third wave. We have the vol event at the 3-4 correction of the fifth wave, right? That's that vol event. We then have the fifth wave in price, corresponds with the A wave of the correction, right? We have a much bigger sell-off in price, but that's not reflected in volatility. The volatility sell-off is nowhere near as big as it was here, right? That's because the big institutional investors have already moved out, right? So this is the fifth wave, and this is the A wave, the B wave, and the C wave of the looming correction should be here, right? What we should see. It mimics that in almost every instance of how Elliott wave moves forward. So we should be, based on where we are now, we should be anticipating the completion of this B wave shortly and the beginning of this C wave decline, right? At least I've been anticipating it. Now, at what level of volatility does that usually happen? Well, in these waves, what we generally see is the lowest volatility occurs at the peak of, right, at this peak here is where volatility is the lowest. At the peak of the third wave of the fifth wave, right here. Just as over here, right? The lowest volatility generally occurs at the peak of the third wave of the fifth wave. Then we have our vol correction, and we retrace back up to, but not the peak, but the peak of the proper third wave in price and volatility, right? Right across that line there, we peak. In our present market, we should be referencing this peak, right? So I put my B right here, roughly $10.50 or $10.50 on the VIX. It's not actually related to cash, but $10.50 on the VIX is where the peak of the third wave is, and we're nearly there, right? We're rebounding to that level. So we should be anticipating from these levels the beginning of the C wave of our correction here. Now that's how do we determine where we're going to go? right? How do we determine that we fall down to 95 or up to 95 because this is inverted? Keep in mind, that's a tenfold move in volatility. If you caught that, you would make 10 times your money in the VIX if you caught that move. That's something I want to catch. We look at this same, how this moves within this fork, right? That same movement, what I can do is overlay that, and we can estimate where it should go based on how we're moving through the larger pattern, right? And let me explain what I mean. Within the larger pattern, which I have marked out as this green fork, within the larger pattern, right, we're expecting a 1, 2, 3, 4, and a 5 to manifest, right? Well, this is how we would simulate that fork, right? The initial 1, 2 move, right? The 3 carries in the top quadrant. The fourth wave should correct to here, much as it did within this fork, right? The fourth wave completes at the bottom of this fork, just as it did in this fork. The fourth wave completes near the bottom of this fork, right? Near the lower quadrant of that fork, right? So if we use this as a guide, we might be able to expect volatility to peak at somewhere around 95 to 100, right? And that pattern should fulfill itself, something similar to this is the fifth wave pattern. So I could copy, right, these bars. I could just drag them over and say I should expect, I should expect something similar to manifest itself, right? I should expect similar performance. Maybe not quite so high, maybe something more like that. That would be commensurate with what we see in the individual waves manifesting itself in the overall pattern, right? The fractal nature of the market playing out, right? We should see that vol event somewhere down here in the 90 to 100 area. And that's what I'm anticipating. That's why I am not anxious to dip my toe back into the market. I want to short these peaks. These are actually the low points because we're inverted, but I want to be shorting these peaks every time because maybe my count's off, right? Maybe this is the time, but I know we're close. So that's a way that I use volatility to identify where we are in the marketplace. And I believe, and I should say that's where I think we are in the marketplace, right? Approaching that next vol event very shortly. What else do I use? Well, I've made myself an oscillator, right? And I use NYSE highs, new highs, NYSE new lows, McClellan Summation Index, and I've kind of combined them into an indicator that I use. And then I have 6-day and 75-day moving averages of that combined information. And that gives me buy and sell signals. And I use this to trade a portion of my funds so that I'm not all in on my own suspicions or beliefs, that I have some level of diversification. And this is happening on a very information-based, out of my hands kind of way. The signal fires, I do what the signal tells me to. And these red lines here are the sells that the system fired off, and the green lines are the buys that the system fired off. And it's done a fairly good job of capturing all the moves and keeping me fairly safe. When the market, when you see these big green boxes, that is what I call an exclusion zone, where the market is strong enough, the 75-day moving average of my combined indicator is above this green line, which I've back-tested and determined that those indicate very strong periods of the market where you don't really want to trade yourself out of positions, right? So those are what I call my exclusion zones, right? When we have these exclusion zones, we don't trade around our positions. We want to hold them. We want to keep adding to them and building our positions, right? And when we exit these exclusion zones, that's when I follow the trade signals that are given by my system. When the orange crosses below the blue is a sell. When the orange crosses above the blue is a buy, essentially. There's a few more complications than that, but that's essentially how the system works. Now here's what the system is telling me. When I look at the 75-day moving average in isolation, it scares the crap out of me. And here's why. When we have new moves manifest in the market, when we have a wave one, this is the wave one that we were just looking at on the VIX chart, right? We see the 75-day average of that information blows up and out, right? Every time, at the genesis of every portion of a new wave. This is the fifth wave that occurred in 2011. It blows up and out, right? This is an incredibly weak portion of the wave that was in late 2015. It blows up and out, right? This is the incredibly crappy, weak portion of late 2018. It blows up and out every time, right? We have had a phenomenal move in markets here in 2018, and this thing ain't blown up and out anywhere. It looks sloppy and it looks ready to roll over, right? This is incredibly weak behavior of this indicator, which is referencing, new highs and new lows in the market are the primary indicator that are used in this system. So I am not on board here. This screams B wave to me. It does not suggest to me that we are in a new rally. To me, this is representative of this area here, just on a much, much larger scale, right? Much larger scale. I'm expecting to see the A wave. We're in the B wave now. We're going to break over, and we're going to have a big trough here, in my opinion. Just what these indicators are telling me. Something similar to this, but on a larger scale. And the system has worked for me quite well. I haven't used it since 2001, but if you just traded the long only, you didn't short anything. If you bought the S&P 500 when this system fired off its first trade, which is 1069, and you held it to today's value, you would have made 88%. If you just traded the long signals only and sold when it tells you to sell, but not went short, you would have made 3,750 points or 250%. So it far outpaces the market. It's beat the S&P 500 by 86% when backtesting. If you included the short trades that the system fires off, it racks up another 1,500 points, right? And the long short total is 5,250 points or 391% and beats the S&P 500 by 161%. So the system does work. It's reliable, and it's kept me safe for a long time with a portion of my money. So I'm not going to go against it. And when I look at the daily version, it looks like we could be ready to roll over here. This thing really has a steep angle of attack. It may deflect one more time before giving us some downside action, but the MACD of this chart doesn't look good, and neither do the indicators at the moment. So I'm not ready to go against this because it has worked for me for so long. When we look at the pitchforks, right? The last video I was saying, hey, we're likely to run to 3080 before we hit some major resistance, and I expect us to bank down off of that. Well, we didn't, right? We decided we're gonna break the trade deal up into sections, and hey, the first portion is ready to go, almost done. So it's amazing, this crap, but the trend line did provide resistance. Now it's providing support, and the market is leaping off of that. I don't think we have much further to go, just based on trend line analysis. I think we're either going to fail here and not hold this line and return, or we're going to clang off a 3140 and really turned down hard. When I look at the market with just in terms of pure Elliott wave analysis, and I'm not factoring in the trend lines to as much of a degree, I believe that we are going to top out shortly here in the 3140 area. We're going to turn back to 3030, make another run at it around 3150, 60. And this will be, I believe this will be a correction that takes us into, first part of December, late, starting this week, I would say, maybe around the 19th, I believe. And then we slide into early December in correction, and we get a brief Santa Claus rally before, another, not a major correction, but something that takes us back into the high 2900s leading into the first part of the year before our final rally. This should be the terminal rally, and that could be somewhere in February, March. At least that's what I think the market's showing me now. I don't think it's ready to break down yet, but I believe it's close. And with the information from the VIX chart, I am going to be shorting every one of these tops with some authority, right? I may stop out and not make any money, but I am not going to be going long the market with authority here. I am looking to, partake in these rallies to some degree, but not get trapped. I want my foot, on the way out the door, and I want to be in position. I want to have my sail ready to catch this wind because I'm still forecasting. You guys are probably so bored with me saying 2,300, but I'm still forecasting 2,300 or lower for the bottom of this correction. What I do want to catch and what I do want to show you is if I'm going to short any one of the markets, I want to get the Russell. And let me explain why. When we look at the Russell, what it tends to do is correct a little and then get hammered. Here in 89, correct a little, hammered. In 98, correct a little, hammered. In 02, correct a little, hammered. 09, correct a little, hammered. Right? In 2011, correct a little, hammered. And again, I want it to correct a little and get freaking hammered. The reason for this, in my opinion, when serious market corrections come along, credit seizes, right? Your Russell 2000 companies many of them are not profitable. They are not investment grade rated as far as their bonds. They have a hard time securing funding, and they have to cut their operations back much more than a company that might be able to get funding or lending would have to. So I want to be, charging after the Russell as far as what I'm going to short, what I want to be in here. When we look at the Russell, it has looked like complete junk of late, and I have a similar count for the Russell as I do for the S&P 500. When we look at this, I've highlighted this in red because this is a 5-wave structure to me, right? That's a 5-wave rally. And we know 5-wave rallies, they can't happen in isolation. It either has to be part of an impulse move higher, which I believe has many people confused right now, thinking that this is a genesis of a new rally, or it has to be part of a zigzag correction, in which case you would have a 5-wave correction, a 3-wave decline, and then another 5-wave correction. And I believe that's what I'm seeing here, right? I believe I'm seeing a 5-wave advance for an A wave. I believe I'm seeing a 3-wave decline, A, B, C. For a B wave, that's a 3, 3, 5 flat. And I believe we're going to this is going to manifest itself as a 5-wave ending diagonal structure, right? Where we have 5 waves that overlap on each other. And I think we're coming to a point where we've either already peaked or similar to the S&P 500. We're going to have one more bank off of this line and then an advance. And we may have already finished that. That advance may be in place now before we start to correct in the Russell 2000. So I'm not saying that hey, the big whopper is coming right away, but I don't know. I can't guarantee that this counts, right? So what I want to be doing is I want to be shorting these peaks, right, every time. Even if I only get this portion, whatever, that's great. That's a lot of money, right? But if I short for this portion and I get, this portion, that's great stuff. That's good news, and that's what we're after, right? So I am not convinced, still not convinced. You're going to have to take this market a lot higher and throw in some different shapes that I'm expecting here to get me to be bullish, right? Now, if we take out, some of these levels that I'm pointing out here in the next week or so, I'll begin to change my tune a little bit, right? If we beat 1618 on the Russell 2000, or if we beat 3140 in the S&P 500, or 3160 in the S&P 500 towards the end of December, if we beat those levels without turning down afterwards, I'm going to have to change my tune and adopt something different. But everything is screaming to me that this is still a B wave. We are still looking at a major decline, and we're even closer than we've been before. I'm still going to be shorting the peaks here. So, sorry if I sound like a broken record, but I'm going to continue to sound that way. Again, just looking for not a major top here this week, but I am looking for a decline to start. It is a good shorting opportunity, I believe, probably around Tuesday. Looking for a 100-point decline in the S&P 500. That's a good chance to make some money. That's going to move into the first portion of December or maybe around Thanksgiving before we find some footing. And then I think we see a rally into the Christmas area before we finally see a more substantial decline, somewhere in the range of 200-300 points on the S&P 500. So that's what I'm looking for. Hopefully you guys are doing well, and you get some time to spend with the family. Have an enjoyable holiday season. I'll probably check in if any of this manifests itself. Probably check in a little bit, maybe when we get to the bottom in early January or something like that, or if something changes my mind. So you guys have a good evening. Talk to you.